Okay, thanks to the committee for having me. It's good to be back after 10 years. I hope I can come back before 2028. My name is Diogo Duarte, and I'm Assistant Professor of Finance at Florida International University. And this is a joint work with Rodolfo, Marcel, and Yuri. So let me try to outline the model that we are trying to address and also present the main results that we have in this paper. So the key idea here is that we are trying to understand risk premium in an economy with incomplete information and where firms can default. So in order to understand risk premium, we first need to understand the behavior on how the two most important factors or component of risk premium, which is quantities of risk and prices of risk, behave. So usually in finance, we refer to quantities of risk, the volatilities and jumps of corporate bonds or stocks or CDS, and market prices of risk are basically jumps in volatility of the state price density in this economy. So if we understand the evolution or the behavior of these quantities, we can assess the evolution of the risk premium. So let me start describing a very basic economy first that will help you to develop the intuition and also the question that we are trying to answer here. So let's suppose we have an economy with a large panel of firms, okay? And each of the cash flows of these firms are uncorrelated. So they are exposed to firm-specific risks, but these firm-specific risks are uncorrelated. Well, it does not mean that the assets written on these cash flows, meaning the corporate bonds or equity, would be uncorrelated in this economy. The cash flows are, but the assets are not. Why they are not? Well, because when you are dealing with Lucas type of economy, we need to get our state price density or pricing kernel from the marginal utility of the investor. So if you have a representative agent deriving utility over the terminal wealth, use market clearing, aggregate wealth will be simply the sum of all the contracts that you have in the economy. Consequently, your marginal utility, it's being affected by all cash flow shocks that are impacting the individual cash flow of each firm. So you have this contagion channel through the pricing kernel of the economy. So despite the fact that, let's say, firm I, has its cash flow only exposed to this uncorrelated shock, the assets written over this cash flow will be impacted through the other firm's specific shocks because of their impacts on the pricing kernel. Okay, so there's this very important contagion channel that will end up impacting all asset prices in this economy. So the natural investigation, the natural question will be, how important is this contagion channel and how does it impact risk premium? We'll show that when the number of firms is extremely large in our economy, this contagion channel will be simply shut down. Okay, we are going in a different direction from what the literature has done so far. And as I will skip and go to a very quick, brief literature review, these two very influential papers published in Review of Financial Studies claim that most of the risk premium that we observe in the market are actually coming from contagion. In order to justify that, they build a production economy model where they do not allow the quantities of risk to fluctuate. So basically, they construct a production economy. Under a production economy, they obtain risk premiums, and the risk premiums coming out of these models, the majority of it's coming from the contagion channel. And we basically arguing that the fact that most of the risk premium observed in their model is coming from Contagion is because they are not allowing for the quantities of risk to fluctuate, meaning they do not allow bonds and equity volatilities and jump to be stochastic. Okay. So let me describe the economy that we have here, and this will help you to understand what we are trying to do. So here, can you please go back to, yeah, thank you. So here we have time, okay, and here is the cash flow evolution. So you have a standard covenant, so if your cash flow is fluctuating, here's the time t, the final part of the economy. Two things can happen with this cash flow, okay? It can experience two types of default. First, there's a smooth default, a la Black and Cox, that the cash flow touch the covenant, and the investors will recover the covenant level at the terminal date, or can be that you're experiencing some reduced form of default, like an earthquake in Palo Alto, and let's say a tech company loses their building. So there's a structural default, a la Black and Cox, or a reduced type of default. Let's suppose that this firm has a debt with face par value P. Okay, so you have a par value P. Well, if this is doing well, we'll model equity as the maximum between the asset minus the par value of that. If it's below, equity holders will be wiped out and the remaining values stay with that holder. So we have relatively basic modeling of cash flows for these firms, but one of the nice things of our model is that we have a consistent balance sheet for all points in time, which is usually hard to get, especially if you have a large panel of firms. So the cash flows that we are considering here are arithmetic Brownian motions, and there is the unknown state of the economy represented by epsilon, so we can be in a good state or in a bad state. The agent does not know which state we are in. And also, each of these cash flow will be exposed to their own firm-specific shock. Okay? Firms are financed by debt and equity, as I explained previously on the board. So for the two types of default, I already explained here in the whiteboard. And we can see then the evolution of the cash flow as being you receiving your dividends or the cash flow if there's no default, plus you receive the covenant if the firm experiences one type of default. Okay. So let me go and briefly describe the incomplete information setting here. So given the two possible states of the economy, we can be in a good state or bad state. This is unknown. The agent does not know which state we are in. So if we are in a good state, we have a higher drift here for the cash flow, and the reduced intensity of this process, it's considered to be smaller than if we are in a bad state of the economy. Naturally, the drift mu b will also be smaller. So the agent is observing this process, will filter in the information, and we'll come up with the probability, a posterior probability of being in a good state that we are denoting here by PT. We present and derive the evolution of PT in our paper, and then we can go and try to price contracts in this exchange economy. So we posit the evolution for corporate bond and equity, and this is the main difference from our paper, relative to the existing literature. So as you can see here, given this relatively straightforward scenario and description of the economy, we'll have the quantities of risk, right? The volatility and jumps of debt and equity. This is what we denote quantities of risk. This will be time varying and stochastic. And when we consider the state price density in this economy, the market prices of risk will also be stochastics given the scenario. So I will not spend time in the details, but I want to call your attention for the shape of the state price density that we are obtaining here. So in the paper, we show what specifically each of these components are, but this is the representation of the state price density. Some average of this capital or uppercase F, okay? So each of these units here, these little f's, that will end up completely describing the state price density. Okay? They are state dependent, naturally, because the agent does not know if he's in a good or bad state. But note that these small blocks here that are forming the state price density, they're only influenced by the firm-specific shocks, right? So you take the n firms, and you can split in n small units that are affected by their firm-specific shocks. So the state price density, as I mentioned at the beginning, it's being affected by all these firm-specific shocks. So naturally, when you use the state price density to price any claim, this contagion channel will make all claims dependent on all firm-specific shocks in our economy. So we define in the paper this concept of a contagion probability measure, that it's simply normalizing these factors here. And why do we care about that? Why it's an interesting representation? Why is, if we pick a claim, a random variable GE, that could be the payoff of equity or corporate debt in our economy, why is it interesting to represent this claim under the contagion measure? Well, so this is the representation under contagion measure, and this is under the physical measure. You can see that this term here, C, it's simply the normalized F factor, and it depends on all the shocks, all the firm-specific shocks, right? But when we go to the contagion measure, the only thing that you care about is the firm-specific shocks affecting this random variable here. Okay, so it's basically shutting down the contagion part of the payoff of the firm. So we go in the paper, characterize market prices of risk, market price of jump risk. We can do the representation under the contagion measure. As you can see, for the market price of jump risk, the only thing that you end up caring about is the firm-specific shocks. And given the fact that we have a arithmetic Brownian motion describing the evolution of cash flows, and a relatively simple preference structure, because we are using Cauchy utility, we still have a very interesting dynamics for both prices of risk and asset prices also, as I will show you. So we take a parameterization very close to Bai and Cawthor's paper and try to see what happens with our equilibrium quantities as we vary some of these parameters. So I don't have time to go all over the graph, so I will call attention for this one, where we increase the number of firms in our economy and try to see what happens with the market price of diffusion risk. So these lines here are representing different levels for the probability of being in a good state. So the red is with 25% probability, you're in a good state. Here the agent is more confident that he's in a good state with 50%, and here 75%. As you can see, as we increase the number of firms, all of them are converging to this lower level here. We can proceed and do the same thing for the market price of jump risk, and we observe a similar behavior. As you increase the number of firms, the market price of jump risk will also decline to this lower level. We proceed then, use this state price density. Now that we are understanding a better market price of risk, we can go characterize the evolution of bond prices and equity in our market. So we will obtain now the quantities of risk, because price of risk we just discussed it. Then we can multiply these two and obtain the dynamics for the risk premium, which is the ultimate objective that we are trying to achieve here. So we perform a bunch of comparative analysis here. The paper we discuss, the graphs, we have similar behavior. As you can see, stock price is also converging to a lower level as the number of firms increase. Same thing for bond prices. And this is something that caught our attention when we were deriving all these results. And the natural question is, can we analytically show that as we increase the number of firms, the panel of firms in this economy, are these numbers converging to some place, or are they going to a lower value as our picture indicates? So I will move now the discussion to the risk premium and then discuss the limiting results that we have. So for the risk premium, we follow buy and co-authors and split the risk premium of debt, equity, and a CDS in two parts. Okay, so the first part is the part coming from the Contagion channel. So these are quantities of risk. For instance, if you're considering firm I, we have, again, N shocks, because we have N firms. Each firm, each cash flow is only exposed to firm-specific shock. But given the Contagion channel through the pricing kernel, the asset risk premium will be affected by all shocks. So let's take here all the shocks with the exception of firm's specific I shock. So we'll call this component the Contagion component, which is nothing but the quantity of risk times the price of risk for all other shocks other than I. Okay? And when we look at shock I and try to assess the risk premium component, or the premium coming from this, the exposure to this shock I, we'll call this cash flow risk premium. So we are simply decomposing the total risk premium in two factors, Contagion part and cash flow part. Okay. Note that we have much more terms here in the Contagion side, and we only have two terms for the cash flow risk. Right? In other studies, these quantities of risk here, they were fixed. So as you increase the number of firms, the Contagion part will end up dominating. So people found that the majority of the risk premium comes from the Contagion part by construction. Because if you fix quantities of risk and increase the number of firms, we will end up mechanically obtaining that the majority of the risk premium is coming from the Contagion. But what if we allow this to vary? What if we allow the quantities of risk to vary? It can, let's say, goes to 0. We don't know. We need to analyze this. But it could well be that as we increase N, the quantities of risk also converge to 0. So even if you're adding new sources of risk in your economy, it could well be that the quantities of risk are converging faster to 0 than you're adding these terms. And this is exactly what we found. So when we increase, we take a very large number of firms and try to analyze this decomposition of risk premium, we saw that the Contagion part of the risk premium was actually very, very small compared to the cash flow risk premium. And the main reason, again, was coming from the fact that these quantities of risk was converging really, really fast to 0 as we increase the number of firms. And we show in the paper analytically that that's the case. So one of the nicest results that we have in the paper is that we can show that these quantities of risk will converge to 0 as we increase the number of firms, meaning that the Contagion channel is shut down in an economy when we have a large panel of firms. And what we care is about cash flow risk, or this risk being generated by firm-specific shocks. We have also price convergence results for bond equity, but given my limited time, I will skip this. We also have results for first default basket, CDOs. So we have a nice analytical expression for all these quantities. If you're interested, we can discuss more. Okay. So concluding remarks, my main message is if you're trying to create a model, trying to explain risk premium or credit spreads in general, you should come up with a model that will deliver endogenous volatility for bonds and equity. So you cannot simply fix the volatility and jump size of equity and bonds and put all the blame on the variability of prices of risk. You need to come up with a model that endogenously generate time-varying quantities of risk and time-varying market price of risk. Okay, thank you.
I must say I like a lot the idea. Any questions?
So I have like one comment and one question, if I may, Raphael. Yeah. Is it all theoretical, or have you ever tried to like calibrate those stuff to real data?
No, it's mostly theoretical. The parameterization that I show you, it's actually related with the one that Bai presented in his paper. Okay.
So maybe if I may like have a suggestion.
Yeah.
There's a lot of empirical studies which have studied the, you know, when for example, a stock index rebalances the components, and suddenly one stock which was not in the index comes inside the index, you see mechanically the correlation with the index increase. And this is typically, I guess, something which is within the paper, right? It's the fact that although like fundamentally there's nothing linked to the index, because it's the index, people price it differently because it's in the bunch of securities. So maybe you can think of something in that direction in terms of calibration. I don't know. I don't know how hard it is. And another question this time. Can you go to slide 7, please? Yeah. I didn't get the... Yes. So B is the value of the bond?
Yeah, it's the corporate bond.
And S is the equity?
Equity, yeah. You're financing your company through corporate debt and equity.
But isn't like equity the difference between the value of assets and the bonds? Or?
Yeah.
Yes. Okay,
this is the structure. Yeah. So it's a consistent balance sheet.
All right. So it's consistent.
Yes, exactly. So we're getting assets as the sum of debt and equity.
So when the equity goes to 0, like S goes to 0 in slide 7, the bond exactly is equal to the value of the assets?
Yes, exactly. So here, so you have only 2 cases, right? If in the middle of this way here, there is a default, what happens is equity holders are wiped out.
Yes.
They don't receive anything. And the debt holders will recover the covenant, right? There is a covenant that you recover.
Okay.
Okay?
Thank you.
The true mechanism is a bit more complicated. There's been some research saying that, in fact, the difference, so the value of the equity behaves a bit like the square of the remaining. So how does that work? In fact, you may have even some.
Yeah, you have several layers of recovery.
The assets can still be below the debt, and people will still value with the equity to something.
True.
It's a bit more complicated. No, but I like a lot this idea. Any other question?
Is it somehow important if firms are financed more with equity or more with debt? Because this seems like a Modigliani-Miller economy, so it shouldn't matter at all. It's just a question of...
Excellent point. Yeah, in this case, it does not matter, right? We have in the same style of Black and Cox, so we have nothing to say in terms. It's not going through like Leland type of model where you have incentives to issue that, but no, we have nothing to say in terms of optimal leverage here. Yeah.
Thank you. Well, let's thank again the speaker.
Thank you.